Today, we are going over the PPI index, Producer Price Index. It essentially goes over the price increases or decreases from the seller's side, from the producer's side. And that's very important because it is an indicator. It predicts what the companies are going to do in the future. If these numbers are coming back higher than expected and producers, sellers are dealing with more inflation, then they're going to have to increase the prices. And so it's kind of a lagging, or it's actually a leading indicator where we get to see how companies are going to react, which then affects the CPI and overall inflation. And so we'll kind of look at the numbers and see if it's good or bad in a second. But that's something to kind of think about is if these numbers come back high or if these numbers come back low, it determines the price of things in the future. So let's go. So what did we get? We got better than expected at 0.2% increase opposed to the 0.3% increase we were expecting. And if we kind of break these numbers down a little bit, so total, we saw the same as last month at 0.2. And what's really important though is demand less food and energy and trade because those are very volatile and the Fed does not have a lot of control over those aspects. So the interest rates raising and monetary policy tightening doesn't really affect foods, energy, and trade as much because they're just very volatile. So that actually decreased from last month, which is great. Great. And we can kind of see here, right? Energy. Energy is a big contributor, right? 60% of the increase in prices contributed to gasoline, which rose 5.7%. So that is kind of where we see that difference in total versus getting rid of energy, and how that is on a downtrend now once you get rid of energy and food. Right, so like right here, energy. When energy is down 9.1% or 5.4%, it is going to bring this total right here down with it. And when it's up, on the contrary, right, it's going to bring it with it. So it's really important to kind of determine if you want to look at the numbers less food and energy or the numbers with it. And for our situation in the moment, it's okay to look at it without because the Fed does not have a lot of control over food and energy prices. So their rate increases will not really factor in energy or food prices. And that's the beautiful thing about this. So what does this mean for the market? Well, we have seen some very, very solid gains after the CPI report and now after this PPI report. People think it's evidence that the Fed can now ease back on their rate hikes because inflation is easing back. And, we've seen this before, unfortunately, and not many people believe that we are at the start of a new bull market. We can see this bear market rally being pretty strong, going as high as 4,100 over the next month or so. We're pretty close to that. So we'll kind of see this choppiness a little higher than the recent lows we hit, around 4,100, 4,000. But we're going to really have to see this trend solidify. And that comes with the December 13th numbers. That comes with other numbers. And we got to see it solidify because we have seen trends of 1 month, right here. We saw from June to July a decrease of a very solid amount, right? From increasing 0.9% to decreasing 0.4%. 1.3% swing. But then it turned right around and went up and then went up again as well. So it's very important to kind of look at a more solid trend. 1 month isn't going to cut it. 2 months could cut it. The thing is, if stocks rise and bonds rise, then inflation is going to rise. So the Fed's very cautious about this because we've seen it already, and stocks and bonds rallied, right? And then inflation kind of went back up. So the Fed's going to do a lot of things in their power to keep inflation down until we see a solid couple of months of downward inflation. And that kind of goes back to the statement here. We could see this bear market rally do some nice things. We can make some money off of it. And he says that he would stay fully invested. But you gotta be cautious because stocks and bonds rallying will only increase inflation. So it's not the best move to buy if it is only going to hurt the numbers that control the market in the first place.